Donald Trump just signed an executive order that could reshape the American property market overnight. Foreign buyers, specifically Chinese nationals, are now banned from purchasing residential real estate across the United States. The implications are staggering, and while this might seem like a distant American issue, the ripple effects are already being felt across the Atlantic. British homeowners and investors need to pay attention because what happens in America rarely stays in America. The global property market is interconnected in ways most people don't realize, and when the world's largest economy starts redirecting billions in foreign investment, other markets become the next logical destination. The question isn't whether this will affect the UK, it's how quickly and how dramatically the impact will unfold. If you want to stay ahead of the curve and understand exactly what's happening in the UK property market, hit that subscribe button and give this video a like. Property Reporter keeps you informed with the latest economic and housing news you actually need to know. The executive order Trump signed doesn't just target Chinese buyers, it fundamentally restructures who can own American homes. The stated reason is national security, with officials claiming that foreign ownership, particularly by Chinese nationals, poses risks to American sovereignty and economic stability. Whether you believe that reasoning or see it as political theatre, the practical effect is undeniable. Chinese investors have poured approximately $30 billion into US residential property over the past 5 years alone. That's not a small sum that quietly disappears. It's an enormous wave of capital that now needs to find a new home. When investment capital of this magnitude gets blocked from one market, it doesn't evaporate, it redirects. Investors don't simply give up and go home. They search for alternatives that offer similar returns with comparable stability. The UK property market has always been attractive to international buyers. London especially has served as a safe haven for foreign wealth for decades, with property viewed as a stable asset during times of global uncertainty. British real estate offers legal protections, political stability, and a transparent system that appeals to investors from around the world. Prior to this American ban, the UK was already seeing significant interest from Chinese buyers, but that was when the US market remained wide open. Now, with America essentially closing its doors, the UK becomes exponentially more attractive. Industry analysts are already noting increased inquiries from international buyers, and estate agents in London and other major cities report a noticeable uptick in interest from overseas. This isn't speculation or theory, the shift is happening in real time. Chinese investment in UK property isn't new, but the scale could be about to change dramatically. Between 2014 and 2019, Chinese buyers invested roughly £7 billion in London real estate alone. That figure represented buyers who had options, who could choose between New York, Los Angeles, London, Sydney, and Vancouver. Remove the American options from that list, and then suddenly the competition for UK properties intensifies. The wealthiest Chinese investors aren't looking for modest flats. They're targeting prime real estate in central London, luxury developments, and high-value properties that offer both prestige and investment returns. When demand for these premium properties increases without a corresponding increase in supply, prices inevitably climb. For British buyers already struggling with affordability, this represents another obstacle in an increasingly challenging market. But it's not only Chinese capital that could flood into the UK. Trump's executive order sends a clear message to all foreign investors. If America can ban one nationality today, who's to say others won't follow tomorrow? Uncertainty drives investors away faster than almost anything else. And right now, the US has introduced a massive dose of uncertainty into its property market. Investors from Hong Kong, Singapore, Malaysia, and other Asian economies who previously considered American real estate safe are now reassessing. The UK, with its historical ties to many of these regions and its established legal frameworks, becomes the obvious alternative. European investors who might have split their portfolios between US and UK assets may now consolidate their British holdings. Middle Eastern wealth, always seeking stable Western investments, could pivot more heavily toward London and other British cities. The cumulative effect of all these redirected funds could be enormous. The British government faces a delicate situation. On one hand, foreign investment brings capital into the country, supports the construction industry and can drive economic growth. On the other hand, increased foreign ownership of residential property makes it harder for British citizens to afford homes in their own country. This tension isn't new. Successive governments have grappled with how to balance attracting international money while protecting local buyers. Some cities like Vancouver and Sydney have implemented foreign buyer taxes to cool their overheated markets, and there have been calls for similar measures in London. The question now is whether the UK government will act preemptively to manage an anticipated surge in foreign buying, or whether they'll wait to see how significant the impact actually becomes. Political pressures from constituents struggling to get on the property ladder could force action sooner rather than later. The timing of Trump's order couldn't be more significant for the UK market. British property prices have been relatively stagnant in many areas outside London, with some regions even seeing modest declines. Interest rates have been elevated, mortgage affordability has been squeezed, and many first-time buyers have been priced out entirely. Into this already strained environment comes the possibility of a major influx of foreign capital targeting the exact properties that British buyers are trying to purchase. The upper end of the market, properties above £1 million, could see immediate pressure. But the effects don't stop there. When wealthy buyers get priced out of premium areas, they move to the next tier down, pushing prices upward in previously more affordable neighbourhoods. This cascading effect means that even middle-market properties could eventually feel the pressure. Commercial real estate tells another part of this story. Chinese investment in UK commercial property, office buildings, retail spaces, and industrial facilities has been substantial over the past decade. With residential options in America now blocked, some investors might shift toward commercial UK assets instead, but others will still want residential holdings for diversification. The residential sector offers different advantages. It's tangible, easier to understand than complex commercial leases, and historically stable in prime locations. For investors who made fortunes in China's property boom and understand residential markets instinctively, UK homes offer a familiar investment vehicle. The psychological comfort of investing in something you understand shouldn't be underestimated when redirecting billions of pounds. Regional UK markets outside London might actually benefit from this shift, though perhaps not in ways local residents will appreciate. Cities like Manchester, Birmingham, Edinburgh, and Bristol have been marketing themselves to international investors as offering better value than London, while still providing strong returns. If London prices surge due to increased foreign demand, these secondary cities become even more attractive on a relative basis. Investors looking to deploy capital but finding London too expensive or competitive will naturally look to these regional hubs. For locals in these cities who've enjoyed more reasonable property prices compared to London, this could mean their affordability advantage starts to erode. Estate agents in these regions are likely already preparing for increased international interest, and developers will be watching closely to see if they should adjust their project pipelines. The construction industry could see both opportunities and challenges from this potential investment wave. Increased demand typically spurs more development, which creates jobs and economic activity. However, if foreign buyers are primarily interested in existing prime property rather than new builds, the construction benefit might be limited. Luxury developers in London might see renewed interest in high-end projects that have been slow to sell, but volume builders constructing starter homes won't necessarily benefit. There's also the risk that if foreign investment concentrates in certain areas or property types, it creates distortions in the market, overheating some segments while others remain sluggish. Balanced market growth is generally healthier long-term than rapid spikes driven by external factors. Bank of England officials must be watching these developments with concern. Property markets have enormous influence on broader economic stability, as the 2008 financial crisis demonstrated painfully. A sudden surge in property prices driven by foreign investment could create several problems. It could lead to a bubble that eventually bursts, causing economic damage. It could increase wealth inequality as property owners see their assets appreciate while renters fall further behind. It could also complicate monetary policy. If the central bank wants to lower interest rates to stimulate the economy, but worries that doing so would further inflate property prices, they're caught in a difficult position. Managing an economy is complex enough without massive external capital flows adding unpredictability to the housing market. Legal frameworks around property ownership in the UK may come under scrutiny. Unlike some countries, Britain has relatively few restrictions on foreign property ownership. There's no requirement to be a resident or citizen to buy property, and the process is straightforward for international buyers with sufficient funds. This openness has been viewed as a strength, attracting global capital and reinforcing London's position as an international city. However, if the political pressure builds due to affordability concerns, politicians might consider new regulations. These could include additional taxes on foreign buyers, restrictions on the number of properties foreigners can own, or requirements that foreign-owned properties can't sit empty. Any such measures would represent a significant policy shift and could have unintended consequences for the broader market. The cultural dimension of increased foreign ownership shouldn't be ignored either. In neighbourhoods where significant numbers of properties are owned by overseas investors who don't occupy them, communities can feel hollowed out. Local shops lose customers, schools see enrolment drop, and the neighbourhood character changes. This has already happened in parts of central London, where entire developments are largely empty, owned as investment vehicles or occasional use properties by wealthy foreigners. If this pattern spreads to more areas or intensifies in already affected neighbourhoods, it breeds resentment and political backlash. British voters seeing homes sitting empty while their children can't afford to buy in their hometown creates powerful political pressure for change. Currency movements add another layer to this situation. The pound's value relative to the yuan affects how attractive UK property appears to Chinese buyers. If sterling is weak, British property becomes cheaper in yuan terms, making it an even better deal for Chinese investors. Exchange rate fluctuations can amplify or dampen the investment appeal independent of actual property prices. Currency strategists and property investors are likely modelling various scenarios right now, calculating optimal timing for major purchases. A coordinated wave of buying driven partly by favourable exchange rates could hit the market suddenly rather than gradually, creating a shock that the market isn't prepared to absorb smoothly. Mortgage lenders will need to adapt to changing market conditions as well. If property prices rise faster than incomes, which seems likely if foreign cash buyers enter the market aggressively, then mortgage affordability becomes even more stretched for British buyers who need financing. Lenders might tighten criteria further, requiring larger deposits or proof of higher incomes. This would squeeze first-time buyers even more severely. Alternatively, some lenders might develop products specifically designed to help British buyers compete with cash offers, though what form those might take isn't clear. The lending industry generally reacts to market conditions rather than anticipating them, so any adjustments will likely come after problems become apparent. Property developers and landowners sitting on potential development sites might recalculate their plans. If they anticipate higher prices due to increased foreign demand, they might accelerate projects to capitalise on the opportunity. Conversely, they might hold land off the market temporarily, waiting for prices to rise further before selling or developing. These individual decisions, multiplied across hundreds of developers and landowners, shape the supply side of the equation. If supply doesn't increase to match higher demand, price increases accelerate. The planning system in the UK is notoriously slow and restrictive, so even if developers want to build more quickly, regulatory hurdles might prevent rapid supply responses. International students studying in the UK represent another angle to this story. Chinese students make up a significant portion of international enrolment at British universities, and their families have been active buyers of property near campus towns, both for their children to live in and as investments. With American universities also potentially less attractive due to the broader political climate around Chinese nationals in the US, British universities might see even more applications from Chinese students. This could drive additional property investment in university cities like Oxford, Cambridge, Durham, and others. Student housing has been a growth sector in UK property investment, and this trend could intensify, pushing up prices in markets that were previously somewhat insulated from the luxury London investment patterns. The super-prime market, properties above £10 million, operates in its own rarefied sphere. This segment has been relatively quiet recently after years of robust growth, with some high-end properties sitting on the market for extended periods. An influx of wealthy Chinese buyers shut out of equivalent properties in New York or Los Angeles could revitalise this market segment. Historic London townhouses, country estates, and ultra-luxury new developments might see renewed competition. While this represents a tiny fraction of overall transactions, these sales generate enormous publicity and can influence perceptions of the broader market. They also produce substantial stamp duty revenue for the government, which might make officials more welcoming of this investment regardless of concerns about the mass market. Estate agents are probably the first to see concrete evidence of changing patterns. If they're suddenly fielding more inquiries from Chinese buyers or their representatives, if viewing schedules are filling with international clients, if offers are coming in above asking price more frequently, these are the early warning signs. Property professionals operate at the ground level where macroeconomic trends become visible as actual human behaviour. Their anecdotal reports over the coming months will tell us whether this potential surge materialises into reality or remains theoretical. Some agencies specialise in serving international clients and will be positioning themselves aggressively to capture this business, while others focused on domestic buyers might find their clients increasingly frustrated. Technology platforms and property portals could see shifts in how international buyers search for UK property. Chinese buyers might use different platforms than British buyers, rely more heavily on video tours and virtual viewings, and make decisions with less in-person inspection. Property technology companies that can facilitate smooth international transactions, handle currency exchange, navigate legal requirements, and provide comprehensive remote viewing options will be well positioned. The pandemic accelerated adoption of virtual property viewing technology, and serving a new wave of international buyers could push innovation further. However, this also creates opportunities for fraud or misrepresentation if buyers are making major financial decisions with limited physical inspection. The rental market adds yet another dimension. If foreign investors buy properties but don't occupy them personally, they typically rent them out. This adds to rental supply, which theoretically should help renters. However, if these properties are at the higher end of the market, I don't help people looking for affordable rentals. Additionally, some foreign owners prefer to leave properties empty rather than deal with tenants, viewing the properties purely as financial assets. Empty properties represent a waste of housing stock in a country with a significant housing shortage. Local councils have powers to charge premiums on empty properties, but enforcement has been inconsistent. If the number of empty foreign-owned properties increases noticeably, political pressure for stricter enforcement or stronger penalties will likely build. Insurance and property management industries might see business growth from increased foreign ownership. Properties owned by overseas investors require local management services to handle maintenance, deal with any issues, collect rent if tenanted, and generally protect the owner's investment. Insurance for foreign-owned properties might carry different risk profiles, potentially requiring specialised products. These are smaller economic ripples from the main event, but they represent real business opportunities and market adjustments. The professional services ecosystem around property, including lawyers, accountants, surveyors, and managers, all adjust to serve whoever the buyers are. Looking at comparable markets provides instructive examples. When Vancouver implemented a foreign buyer tax in 2016, property price growth slowed significantly in the immediate aftermath. However, prices resumed climbing once the market adjusted to the new rules, and some buyers simply structured purchases differently to minimise tax liability. Australia implemented similar measures with mixed results. These examples suggest that if the UK eventually decides to restrict or tax foreign buying, it might provide temporary relief, but won't necessarily solve underlying supply and demand imbalances. Additionally, such measures risk deterring desirable investment and sending signals that Britain is becoming less welcoming to international capital at a time when the country is trying to define its global role post-Brexit. The political implications within the UK could be significant. Housing affordability is already a major political issue, particularly affecting younger voters who feel locked out of ownership. If foreign investment is seen as making the problem worse, it could shift votes and policy priorities. The opposition parties might seize on this issue, demanding action to protect British buyers from being outbid by international money. The governing party would need to balance multiple considerations, maintaining Britain's attractiveness to international investment, addressing legitimate affordability concerns, raising revenue through property taxes, and managing the economic impacts of any policy changes. There are no easy answers, and whatever approach is taken will face criticism from some quarter. Scotland and Wales have some devolved powers over property taxation and might respond differently than England to these pressures. Scotland already has a different property tax system than England, and the Scottish Government has shown willingness to use tax policy to pursue social objectives. If foreign investment concentrates heavily in Edinburgh or other Scottish cities, the Scottish Parliament might implement its own measures independent of Westminster. Wales similarly could take its own approach. This could create a patchwork of different rules across the UK, adding complexity for investors but potentially allowing different regions to address their specific circumstances. Northern Ireland typically receives less international investment focus, but could benefit if investors look beyond the usual targets. The environmental angle to property investment rarely gets discussed, but matters increasingly. New developments must meet stricter energy efficiency standards, and there's growing awareness of the carbon footprint of construction and building operation. Foreign investors focused purely on financial returns might not prioritise environmental performance, potentially conflicting with the UK's climate commitments. Alternatively, some international investors are very focused on ESG criteria and might actually drive higher environmental standards by demanding green buildings. How this plays out depends on the specific buyers and their priorities. Government policy could incentivise environmentally sound development regardless of buyer nationality, killing two birds with one stone by addressing both climate goals and property market concerns. Historical perspective reminds us that foreign investment waves in UK property have happened before. Japanese buyers were major players in the London market in the 1980s. Middle Eastern investment surged at various points. Russian oligarchs made headlines with spectacular purchases in the 2000s and 2010s. Each wave brought concerns about foreign ownership, sparked some policy debates, and eventually either receded naturally or was absorbed into the market. The current situation feels different in scale and speed because we're talking about potentially redirecting tens of billions that would have gone to America. The sheer volume could overwhelm the market's ability to absorb it smoothly. However, it's also possible that the impact will be more gradual and less dramatic than the most alarming predictions suggest. Media coverage of this issue will shape public perception significantly. If newspapers run stories about British families losing bidding wars to foreign cash buyers, public anger will build quickly. If coverage focuses on investment bringing money into the economy, creating jobs, and supporting development, the response will be more measured. The framing matters enormously in determining whether this becomes a major political crisis or a manageable market adjustment. Property reporters and economic journalists are now tasked with explaining complex market dynamics to audiences who often have strong personal stakes in the housing market. Accuracy and context are crucial to avoid either dismissing legitimate concerns or stoking panic unnecessarily. Think tanks and academic economists will be modelling these scenarios, trying to quantify the likely impacts, how much Chinese capital will actually redirect to the UK versus going to other markets like Canada, Australia, or Singapore. How price elastic is the UK property market, meaning how much do prices rise for a given increase in demand? How will British buyers change their behaviour if prices climb further? Will more people give up on ownership and resign themselves to renting, or will they stretch finances even thinner to buy? These questions don't have simple answers, but the research being done now will inform policy debates over the coming years. Evidence-based policymaking requires good data and analysis, though political realities don't always align with what evidence suggests is optimal. The next 12 months will be crucial in determining how this plays out. If we see a surge in foreign buying that drives noticeable price increases, particularly in London and other major cities, pressure for government action will become irresistible. If the impact is modest or takes longer to materialise, the issue might simmer without reaching a full boil. Estate agents, property analysts, and market observers will be watching transaction data closely, looking for changes in buyer composition and pricing patterns. Leading indicators like inquiry levels and viewing appointments will provide early signals before they show up in official statistics. Anyone involved in the UK property market, whether as homeowner, investor, or industry professional, needs to pay attention to these developments. For British citizens hoping to buy their first home, this situation adds to an already daunting challenge. Property prices relative to incomes are near historic highs, deposit requirements are substantial, and mortgage rates remain elevated compared to the ultra-low rates of recent years. The possibility of increased competition from foreign buyers makes the dream of ownership feel even more distant. The psychological impact of believing the system is rigged against ordinary people in favour of wealthy foreigners can't be underestimated. It breeds cynicism about whether working hard and saving diligently actually leads to achieving life goals. Politicians ignore these feelings at their peril, as frustrated voters look for parties offering solutions, even if those solutions involve significant policy disruption. Property wealth versus earned income represents a growing divide in British society. Those fortunate enough to own property, particularly if they bought years ago, have seen enormous wealth gains through appreciation. Those who don't own property, especially younger generations, fall further behind despite working just as hard. When foreign investment accelerates this divergence, it adds an international dimension to what's already a significant domestic inequality issue. The social contract that said, if you work hard and save, you'll eventually own a home, feels increasingly broken for many people. Rebuilding that sense of opportunity and fairness might require fundamental rethinking of how housing is treated as both a human need and an investment asset. What happens next depends on choices made by governments, investors, and individuals across multiple countries. Trump's executive order was one decision by one government, but its ripple effects could reshape property markets across the developed world. The UK stands at a crossroads. It can welcome the investment and deal with the consequences, restrict foreign buying to protect local affordability, or try to find some middle path that balances competing interests. None of these options is perfect. Each involves trade-offs and risks. The property market touches so many aspects of economic and social life that getting these decisions right matters enormously. For now, all we can do is watch closely as this situation develops and be prepared to adapt to whatever the new reality becomes. The one certainty is that the UK property market of 2025 and beyond will be shaped significantly by decisions being made right now in Washington, Beijing, and London.